Gold is holding near elevated levels, but not behaving in a way markets would typically expect. Yields remain firm, the dollar hasn't broken down, and yet the downside in gold has been limited. Now, it's a tension that's raising bigger questions about what the market is really pricing. Well, against that backdrop, some analysts argue there is still a rate-driven trade, while others say it points to something far more structural unfolding beneath the surface. Well, joining us now is Alasdair Macleod from MacleodFinance.com. Alasdair, let me just sort of open up this with a quick curtain raiser question. Gold is holding near elevated levels. Now, that's despite firmer heels and a resilient dollar. What is the market really signaling right now?
I think the market is signaling some considerable confusion. But if you look at equities, for example, they're hitting all-time highs when surely any reasonable analyst would say that the presidency of the United States is in trouble. And not only that, but foreigners no longer have use for the dollar. The petrodollar is, to all intents and purposes, dead. So there are lots and lots of excess dollars around. And even if you look at the Treasury tick figures, foreign ownership of dollars, if you take the various forms of debt and credit, total about $44 trillion, of which more or less half is invested in equities.
Yeah.
I mean, this is absolutely crazy, in an economy which is only about 30 trillion US dollars up by GDP, and a nation which has a similar level of government debt. I mean, it's just extraordinary. The whole thing is quite extraordinary.
And it's interesting you frame it that way, because if I look on the other side of the spectrum, US 10-year yields still in mid-4% range, right? And real yields positive. Isn't gold behaving more like a macro hedge than a systemic warning? What's your take on that?
That's not the way I look at it. I mean, if you actually look at the legal position of gold, it is final settlement without counterparty risk. It is properly money. Everything else is credit. And this was actually pointed out to Congress back in 1912 by the great banker, John Pierpont Morgan. He said, gold is money and everything else is credit. And he's dead right. Legally, that is the position. The problem, I think, is that the investment world has forgotten that and replaced, if you like, what follows from that position with macroeconomics, which is a non-science. I mean, the idea that governments can intervene in an economy and manage outcomes always comes to grief. And when you, let's say, do away with the backing for credit, in other words, credit is no longer encashable for real money, which is gold, then the value of that credit just goes down and down and down at a rate which is determined by the way in which governments corrupt it. So, I mean, that's the basic background we have. But against that, and I think one answer to your question is that when it comes to risk, if you like, regulators tell investment managers that because gold is not a regulated investment, they must severely limit any attention they give to it. And of course, that then has the knock-on effect in the mining sector and so on and so forth. So you have sort of hundreds of trillions of portfolio assets. I think they're currently estimated something like 300 to 350 trillion dollars equivalent all around the world. I mean, it's actually quite unusual to find an investment manager who goes against this and recognizes that gold actually is money and the rest is credit. But for an investment manager trying to comply with regulatory oversight, compliance officer and all the rest of it, his risk-free position is cash in the currency in which he accounts. So you can see there's an immediate tension between the reality and what an investment manager is forced to do.
Yeah. Looking at how this plays out in China, because you've spoken a lot about that recently, right? You argue demand is far higher than reported. How confident are you your numbers reflect true end demand and not internal flows or double counting?
I'm entirely confident.
Yeah.
It's not a question of double counting. We have known for decades that gold has been stripped out of Western capital markets and gone into China, which, as I've written in my recent article, I mean, China is like Hotel California for gold. I mean, you know, it can go in, but it can't get out. So that is the reality of it. And of course, the Chinese authorities brought in regulations in 1983, appointing the People's Bank of China with sole responsibility for managing the national gold and silver reserves. And we don't know how much they tucked away. I mean, I quoted Article 3 in those regulations, which basically states that the gold and silver acquired by the PBOC as dealer in these, as exclusive dealer in these metals, could be tucked around various state organizations like the army, the youth movement, and so on and so forth. So, and indeed, I have been given anecdotal evidence that there are substantial quantities of gold held by the People's Liberation Army, for example. So this is something which I don't think is necessarily new, but what we don't know is the exact quantities that the state accumulated. But what we do know is that at the same time, the state ramped up gold mine production so that from 2007, it overtook South Africa as the largest nation by gold mine output and has retained that position ever since, typically producing anything between 350 and 450 tons a year. I mean, it has been declining a bit recently, but they are still the largest nation by mine production. Couple that with, the Hotel California bit, you can see that there is a huge emphasis on ensuring that the state has sufficient gold to cover its currency liabilities at some stage in the future. And it was only in 2002 that the citizens were then allowed to buy gold. And they set up, the People's Bank of China set up the Shanghai Gold Exchange, which it controls to this day, as the mechanism for delivering gold, physical gold, to the public. And since then, the gross value of the gross amount of gold delivered into the public has been in the order of about 28,000 tons. That's quite a lot of gold. And on top of that, of course, you've got the banks who offer gold accumulation accounts to their deposit customers. And for as little as 500 yuan, which is about $75, you can open a gold accumulation account and instruct your bank to transfer every month an amount like, say, 100 yuan into your gold accumulation account. Where else are you going to save? And household savings there are accumulating at the rate of over $5 trillion equivalent every year. I mean, we're talking not trivial amounts. So I think in a sense, while, China has been very much in the headlines in terms of acquiring gold and so on, and nobody quite knows how much, nobody quite knows how to analyze it. I think the problem in terms of gold liquidity, physical gold liquidity, is probably only just starting.
You will still have those, though, Alasdair, that says if central banks, particularly China, are absorbing so much supply, why hasn't gold broken out more decisively? You still have those that will ask that.
Yes, indeed. I mean, it ran up, much to the embarrassment, I think, of the American government and also perhaps the European governments who are fully on side with America in terms of, we look to the dollar, if you like, as the replacement value for our currencies rather than gold. So I wouldn't rule out that there was some sort of push, if you like, to try and get it lower. And of course, the other thing is that if you look at the position on COMEX and in London, particularly in silver, you ended up with a huge, great squeeze. I mean, the silver lease rate jumped up to 40%, I think, on the 9th or 10th of October last year. Gold has got a lot more liquidity. That's not quite so bad. But if you really want to buy large amounts of gold, you go to one of the Swiss refineries and they say, back of the queue. I mean, there's one point worth making, and that is that central bankers around the world actually do understand the distinction between gold as money, final settlement, no counterparty risk, and fiat currencies. And guess what? They've been piling over themselves trying to buy physical gold and sell fiat currencies. And when you look at what the People's Bank of China has been doing, you would think they've been buying gold. That's actually the wrong way to describe it. What they're doing is they're selling fiat currencies.
Yeah, I was just going to bring that in because, if physical demand in Asia is as dominant as you argue, again, there are still those that would argue that paper markets appear to set the global price still.
Well, yeah, I mean, they do, because that's where the portfolio flows are. I mean, they're very much in the Western markets. But, I mean, I've just seen a tweet, which I can't verify, but it's sort of fairly reputable source, I believe, saying that in the last month, China's imports of silver is at a record. I mean, what we're seeing is not so much arbitrage. We're just seeing Western markets being drained. And then there was, I think it was last month, they were saying that, if it wasn't for the exports of gold out of America, I mean, they basically covered the trade deficit. I think that's a silly way of looking at it. That's the way that the Indian government looks at it as well. They don't like to see gold coming in because it screws up the trade figures. But nonetheless, I mean, the gold and silver are still migrating from west to east, and the quantities are not diminishing.
Yes, I want to chat about silver in a moment, but very quickly, let's take a look at your mining minutes. You're watching Mining.com Minutes. Agnico Eagle Mines is making a powerful $3 billion play to dominate one of Europe's hottest gold districts. At the center of it, a $2.1 billion takeover of Rupert Resources, backed by additional deals with Orient Resources and B2Gold's stake in the Fingold joint venture. Now, if it all goes through, Agnico secures full control of a massive land package in Finland's central Lapland Greenstone Belt, a region rapidly emerging as a gold powerhouse. So what's the prize? Potential production of around 500,000 ounces a year within the next decade. And the strategy is clear. Plug these assets into its flagship Kittilä mine, unlock synergies, drive down costs, and build a major long-life gold hub in Europe. For more details, go to mining.com. So we're chatting with Alasdair Macleod, and I want to bring in silver, Alasdair. We've seen it push higher in recent weeks, briefly testing multi-month highs, but it still lags gold, doesn't it, on a ratio basis? So does that price action support your view of a tightening physical market, you think? Or is silver still behaving like an industrial metal tied to growth expectations?
Yeah, that's a difficult one. I mean, you say that, the rate has been, the gold-silver exchange ratio has been rising. I mean, but bear in mind that it's fallen from a high of 120 down to current levels, which are 60 and change or something. It should be on its way to below 20 if silver is actually to be regarded as money. Now, the problem we have here is that in certain parts of the world, silver is still regarded as money, particularly in China. And also, I mean, I remember, going around the Gulf when I was about, sort of 19, 20, in the late 1960s, and Maria Theresa silver dollars were still being used in Arab nations. They trusted that money rather than paper money. So, the idea that silver is money is something that is not too far back in history as far as the entire Asian continent is concerned. But against that, of course, industrial use has expanded very, very rapidly. And it has become so important, not just for photovoltaics, but also virtually all electronic and defense applications. It is a vital metal being the best conductor of all the metals and having its own specific properties. So much so that America has turned around and said, finally, this is a critical mineral. The problem, I think, for Western capital markets is there's such a lack of liquidity in silver that it can get squeezed up very, very quickly. But equally, when the heat comes off, my God, they can bang it. And if there is anyone who is stupid enough to speculate in such a volatile situation, they get margined out. And so that basically, I think, is what happened, which took silver down from 120 down to, 60 or something, more or less, in a matter of a few trading sessions. So the volatility, if you like, is because of our system, not because there's some sort of huge fundamental change in the demand for silver. That demand is still there and growing. And China is no longer providing us with that excess liquidity or the marginal liquidity to put a lid on prices.
I want to move on to mining equities, but before I do that, what do you see in the medium term happening with that silver price in the long term, Alasdair?
I think silver price is heading higher, gold is heading higher. And as I say, the way to look at it is it's not so much precious metals going up, but it's fiat currencies going down. And I see nothing to stop the acceleration and the collapse of purchasing power of fiat currencies. We are, in my view, coming to the end of the fiat currency era. And that basically means that if we do see the end of the fiat currency era, then fiat currencies become completely valueless, which means that gold and silver priced in fiat currencies is somewhere towards infinity. Now, we have to see how things develop. But when you look at how, what actually drives economic policy, it's not common sense, it's not economics, which incidentally macroeconomics doesn't properly address, but it is politics. And in these states, if you like, welfare states, who is going to have the guts as a politician to cut welfare, to not continue to manage, if you like, the economy by subsidizing it when things go wrong, and they are about to go wrong big time, as we can see from the oil crisis in the Persian Gulf. No politician is going to do that, because guess what? He gets chucked out of office. It's the reality of it. So, the answer basically is, in terms of what you do with your wealth, you stop really trying to accumulate wealth. What you do is you protect what you get, what you've got, get out of credit. And if you must own equities, it's got to be mining related, because that's where the future is. Because it's not just gold and silver, but all commodities will rise, reflecting the continuing and accelerating collapse in the purchasing power of the dollar and allied fiat currencies.
And that's where I want to come in, because there's been a persistent debate around mining equities. Even with gold near highs, many producers and juniors, Alasdair, haven't kept pace. Is the market signaling cost pressures, you think, and in capital discipline, or are mining stocks fundamentally mispriced relative to bullion?
I think the point about pricing, first of all, is that it's an emotional thing. Yeah. And it depends on where the credit that is available to invest is actually directed. And we see this graphically with AI stocks, for example. As regards costs, that actually is, I think, probably the important thing you've got to look at, because without doubt, the most expensive element, if you like, of mining is fuel, it's energy, it's diesel. So if you have a situation where those costs rise faster than the value of a mine's output, then that mine is just going to go bust, basically. So you need to look at that dynamic very, very carefully. And it probably, I mean, to an extent, a mine manager can get round it by going for, if you like, higher grades as opposed to the lower grades. I don't know. I mean, it could be that it might disadvantage open cast mining with very low grades. It might benefit, if you like, the sort of South African traditional model of deeper mining. I don't know. I mean, you've got to look at the specifics. And I think the other thing which is interesting is that the one thing that doesn't have the fuel costs, of course, is gold in the ground. So if you can see a mine, if you like, that manages to prove up reserves, and there's a chance that those reserves are going to be improved even further, as long as they don't have to buy a lot of diesel, if you like, that actually could give you the better returns, because that will be more directly linked, I think, with various risk factors, obviously. It'd be more directly linked, I think, to the move in the bullion prices.
Well, look, it's really compelling insights. And Alasdair Macleod, it's been a pleasure. Thanks very much indeed for your time.
That's my pleasure.